when I was in the UK, I reached out to Cambridge University because they had a trading and quant trading society. And I thought, being fairly local, I was about an hour away from Cambridge, that it'd be a fun group to join with because I was trading at the time from home. And just to mix in with other traders, it's generally quite a lonely profession. We all are just sat in our rooms like this one, trading away, and there might be someone right next door, and you have no idea that you're there, and to share knowledge, ideas, and so on. So anyway, I reached out to Cambridge, and the president of the society said, "Yeah, come in, sit in on our society meetings." And they did every term they did guest speakers and stuff. And because of the name Cambridge University, they were able to leverage that and get in some quite big speakers to talk in front of their trading group. So I attended one of these talks, and these guys from Bank of America came in, and these various other funds showed you how they were trying to systemize their trading strategies. And it's fairly interesting. They were just coding strategies and running them and seeing what happened. But it's definitely not as easy as YouTubers would have you believe. Anyway, so I attended a society meeting, and I offered to, because I actually trade as opposed to the society members, the society said, do you want to present how you trade? And I said, sure, no problem. I'll give you kind of rough broad strokes of the idea behind my trading strategy. So I wrote a presentation, and I thought, well, I might as well stick it on YouTube right now. So here it is. This is what I presented to Cambridge University Quant Trading Society. Right. So the basis of the strategy that I presented is this. Market assumption. We know nothing. What does that mean? Well, it means we are not predicting or trying to guess future movements in direction. It's very hard to do, but that is the first assumption. Second assumption, volatility is the only opportunity. Now, that's going to make more sense in a second. So how do you make the most of assuming that you know nothing and volatility is the only opportunity? Well, we're going to use options to make money out of those two things. So in most trading strategies, in my opinion, they go about it the wrong way. So for example, looking at technical analysis, which probably applies to most people for their basis of knowledge, they will try and buy on support, or where buyers are, and sell on resistance where sellers are, with trend, and they'll put on these levels with lines, horizontal lines, and trend lines and moving averages and all this sort of thing, and then they'll try and guess what is gonna happen, like a turning point. For me, it's the wrong way. What you should actually trade is the failure of the support level. It's the failure of a trend line, because if most people are buyers at a certain level, if it breaks, they're all gonna capitulate with their stop losses. So it's a stronger trade not to bet on something happening. It's a stronger trade to bet on something not happening. Again, on previous videos, I've talked about being the casino. They look for 51% edge against your 49. They don't look for an 80% edge. They literally look for a 1% edge. So when you're trading, try and think of your strategy from the bookie's perspective. You want to be offering something that others are willing to take. It's why I don't like risking 1 to make 3. I would rather risk 3 to make 1. Then I'm the bookie. It's why most new traders or newbies buy at support, sell at resistance, or at least try. They buy on trend lines. Experienced traders will sell the break of a support line. They'll sell the break of a trend line. Now this strategy, let's get back to what this is. People buy options as protection. They will buy a put option so that if the market goes down a lot, that's like their insurance contract. If the market goes up a lot, they'll have bought a call option, and that will make a lot. Now, there's the other side to the market of the sellers of those options or those insurance contracts. Now, an insurance company makes money by selling you your insurance, and you pay them the premium. And for most of your lifetime, there's only one way your insurance premium goes. I'm sure you can all agree with that. So why not in the markets be the insurance underwriter? Continually offer insurance contracts out there when it suits you. So this strategy is you're buying the risk premium via selling of an option, which gives you a short implied volatility position. Now we need to break down a couple of things. Because we don't know anything, as in we don't know which way the market's going to go. No one does. It's hard to come to terms with, I know, and I know you'll want to have an opinion. But the unknown of tomorrow, of next week, of in 2 weeks' time, like if someone said the S&P's at 5,900 right now, which I think is roughly at, where will it be 2 weeks today? Exactly, where will it be? No one on planet Earth knows that number. So that unknown has value, and that is what you're doing when you sell options. Now, it's not as easy as that, though, and we'll step through that. So for every option available that you're willing to sell, a portion of that option is unknown premium, and that's how you're looking to make money. This is a representation of implied, so that's the sort of future volatility, versus realized, which is what the actual volatility was. And that's the difference between the blue and the pink, for all intents and purposes. And what you can see is that for long periods of time, the implied is greater than the realized. And rightly so. The unknown comes at a premium. And that's where you make your money. And then every now and again, these spikes that you can see on the chart is where where there's been an expansion of unknown, and it then pulls up the realized amount to actually, when it closes, when the option contract closes, it's greater than the implied would have suggested. And then it settles back down, and again, for the majority of the time, the implied is greater than the realized. So then you've got to think to yourself, well, okay, I'm an insurance company. How do they do it? Well, they have lots and lots of trades on, don't they? And lots of small premiums. So you want to be writing, so my strategy, I write lots and lots of insurance contracts, hundreds. And then if one company happens to have a massive blowout move, all my other premiums come together to cover that loss. And the idea is that over time, just like an insurance company, you come out ahead. So the main basis behind an insurance company and behind selling options is your risk of ruin. You have to hold enough cash for that large underlying movement. So it's a strange position to be in most of the time, because you've got all this sort of spare cash for the hurricane event where you have to pay out loads of money. But when you work out, so I used to calculate based on today's, so I used to use the VIX mostly. With a VIX so right now it's at 22. Generally, if you look historically, the VIX can get to 80 for real brief periods of time. So my portfolio needs to be able to withstand an 80 VIX. So I would calculate how much money I needed to cover that shift from a 20 VIX to an 80 VIX. If you need the maths on this, let me know in the comments. And then I'd also calculate a 30% drop in the market, and I'd need my portfolio to be able to withstand that, as well as the expansion in volatility. Because when you get a crash, you generally get that big down move and that vol expansion. So my risk of ruin, I want it to be as close to zero as possible. And I would constantly model my option portfolio against a large expansion in the VIX and a big directional movement. And it's always to the downside. That is to make your risk of ruin as close to zero as possible, if not zero. So to achieve that low risk of ruin, you want a maximum 2% per underlying. So I'd write option contracts. So I'd go in and sell options with a max 2% per underlying. This is leveraging the law of large numbers. So I'd have as many trades as possible while inside my risk of ruin at 0. And yeah, that's the stress testing of that capital allocation. Constantly checking that if we have a large move, how much am I going to be in drawdown, and will I survive? And then the idea is that you just, for the most part, just like insurance companies, they're just creaming these risk premiums. And so you want to sell the options. This is now the kind of the source. You want to sell your options when they are at a high volatility, because then if they were to expand, there's not that much expansion to go. So if you picture a balloon, tight balloon, so this is a low volatility option contract. It has the space to have a huge expansion. Whereas I'll look to sell options on stuff that's already risky. So the balloon is already like half size to like 3/4 size. And there's very little expansion left for it to go. That would also limit my downside. So you're then searching for stocks that are already with high implied volatility. That also minimizes your risk. And so they're not easy to find. They're easy to find. Companies that are in the news, have earnings, lots of action. They generally have a high implied volatility, and you're searching those out. And then as the volatility goes from a stock, so let's say it's waiting on earnings or it's waiting on a like government contract or waiting on some news. Once that news is gone, the volatility vanishes, and then you close the trade, move on to the next one. So you have this, unlike an insurance company that just kind of rolls it all the way to expiry and keeps renewing and taking its premiums. You can just continually roll your options contracts on companies, but you can also close them completely at any time you want. So if you put on a trade today and volatility drops tomorrow, you can close the trade and move on to something with better volatility. You're basically looking for that implied volatility to leave the contract you're in, close the trade, and then find another opportunity. So it does come in waves. When there's a spike in stock market volatility, there's lots of opportunities, and that's when you deploy your capital. And it's easier to deploy your capital in volatility expansions because you can measure, there's much less risk. So it's the hardest thing to do, because when the market's crashing, that's when you have most opportunity with the strategy. So it does take some mind management, because most traders, when the market is most risky, run away or say things like, I'm waiting for like confirmation, or I'm waiting for things to calm down. It's totally the wrong thing. That's when you want to be loading up, when things are like absolutely going nuts, because your downside is limited. Some portfolio metrics, because remember, this was to Cambridge grads, so I was trying to up my IQ level when I gave this presentation. The portfolio will be delta neutral. What does that mean? Well, it means I would generally sell both put options and call options. So you'd create either a strangle, a straddle, or an iron condor on your underlying. Easy to find, just grok it, and it will tell you all about it. And by having them equal, would create a delta neutral position. So you'd sell premium on both sides, and you'd be betting on the stock staying within your two strike prices. 0.2 theta as a ratio of net liquidity, pretty straightforward. And then you want to be using less than 50% of your net liquidity in your portfolio. Again, that depends on the level of the VIX at the time of trading. When the VIX is high, you want to be pushing your allocation as much as possible within your stress test, a risk of ruin like management tool. How do you manage it? So we sell the short premium strategies. That's your strangles, straddles, iron condors. You adjust your portfolio pretty much continuously. Some people will adjust like once per day. Others will adjust just continually. If you don't know that much, you have your strangles. So you've sold a call and you've sold a put option with your stock price in the middle. When the stock price moves, which it will, you need to readjust your options to keep your deltas neutral. Again, grok it or ask in the comments if you need me to go through what all this means. And then you're going to remove old trades. Once the volatility has come down and you're showing a modest profit on the trade, you close it and move on, and you add new trades that have higher implied volatility. My angle with the Cambridge University was that this could be managed by an algorithm. And if they wanted to be, it was like the quant society. If they want to be quants,
or write an algorithm that trades this, because to pretty much all extents and purposes, this could be coded, was my belief. So I was suggesting to them to build like a Python script or something that maybe suggested trades or maybe even auto-executed them. This was my P&L at the time to give them an idea of kind of how it looks. This is a few hundred trades over a couple of years. There are, you can see sort of periods where you kind of go sideways. The drawdowns are actually not too bad. And then it's, you've got to remember, you are an insurance company. So you do expect to make a profit on this strategy. And kind of my P&L represents some kind of profit that was achievable. And that's, I've just put on top all options. I haven't put numbers or a timeline because, it's all relative with regards to what the numbers actually are. But that's the P&L for a couple of years. That's the summary of the strategy that I presented to Cambridge University. It's the selling of put and call options to make money from the risk premium that's out there and people are willing to buy because of the unknown. Pretty simple strategy. It's the management of it that's, I guess, the tricky bit, or the bit you need to concentrate on. You need a good spreadsheet. You need your variables. You need your risk of ruin. But yeah, I hope that's useful. I think I've covered everything. Please, ask all the questions in the comments because I don't know what you guys don't know. All right, that's it.